Welcome to this explainer. Today, we're diving right into Mastering Business Planning Level 1. Let's kick things off with the absolute basics, right? What exactly is business planning anyway?
So we'll be navigating through 6 key areas today. We've got core concepts in planning, types, levels, and elements, organizational and business structures, market analysis and finance, core Q&A, and finally, applied Q&A. At its very core, business planning is really just about how to start a business or expand an existing one. It's a logical decision-making process, one that's based on market analysis and forecasting, and it's used to set a company's goals and objectives. The plan isn't static either. It's continuously updated using a feedback system and by actively measuring performance. In the simplest terms possible, a business exists to maximize profit. And the plan? Well, that's the strategic roadmap to actually get you there.
Section 1. Core Concepts and Planning. Let's break down those foundations.
At its heart, a business plan is essentially a formal statement of your business goals, the reasons why you believe they're actually attainable, and your specific strategy for reaching them. Think of it as the ultimate master document where an entrepreneur summarizes a proposed venture and spells out exactly how the strategy will be brought to life. It covers the whole shebang, outlining target customers, scoping out competitors, and detailing the facilities needed for production. It maps out management, marketing, and finance functions, usually looking ahead over a timescale of 3 to 5 years. Now, you might be wondering, why do you actually need one? Well, it is absolutely essential if you want to raise capital, develop a crystal clear game plan, avoid massive mistakes, and confidently pitch the venture to investors. And on a day-to-day basis, keeping that plan up to date helps you seek funding, win new clients, stay hyper-focused on key priorities, support your budgeting, and set really clear targets for your staff.
When it comes down to it, building a plan really involves 4 main steps. Step 1, you've got to set your vision and mission. Step 2, you carry out an internal analysis using a SWOT framework, paired with an external analysis using PEST or PESTLE. Step 3 is setting your targets and developing a robust strategy. And finally, Step 4, you actively monitor those strategies you've put in place just to ensure you're actually staying on track.
Now, you might be scratching your head about the practical difference between a vision and a mission. Think of it like this. Vision is what you want to become tomorrow. It's the big dream, right? Maybe you want to be the absolute best contractor in the next 10 years, or you want to increase your turnover by 5 million. Mission, on the flip side, is what you do today. It's how the business is actually going to achieve that grand vision. Your mission statement is the fundamental reason you exist right now. And what about values? Well, they are what the organization truly believes in and how it will act. Your values lay the foundational bedrock for what the company cares about most, anchoring both the mission and the vision.
Okay, moving on to Section 2, Types, Levels, and Elements. Let's look at how to actually structure this plan. It is super important not to confuse the types of business plans with the levels of implementation. They're totally different things. First, there are 4 distinct types of business plans. You have a strategic business plan, which is your big 5 to 10-year long-term outlook. Then you have a departmental internal plan, which sets specific objectives for individual departments. An operational plan is a shorter 2 to 4-year plan dealing with day-to-day activities. And a corporate plan defines exactly what business the organization should be in and how it plans to compete. Now, when a business plan is actually rolled out and implemented, it operates on 3 different levels. The corporate level affects the entire company. It's broad and long-term. The management level trickles down to affect each distinct area of the organization, usually broken down into monthly or quarterly periods with a lot more detail. And finally, the operational level affects individuals. It's highly detailed and can be broken down into days or literally even hours.
As for a plan's lifespan, they generally fall into 3 basic timelines depending on the nature of the business. Short-term is usually around 6 months, medium-term sits around 5 years, and long-term stretches all the way out to around 10 years.
So what actually goes inside the physical document itself? Pulling together the core elements, a comprehensive plan absolutely must include an executive summary, a business description detailing your background, products, and services, and a market and industry analysis that assesses your customers and competitors. You're also going to need a sales and marketing strategy, alongside a breakdown of organization and management. Crucially, you have to detail your funding requirements, financial projections, and an operating plan with clear timelines and milestones. Oh, and a SWOT analysis should run throughout the whole thing. In short, the document explains your concept, analyzes the market, presents your strategy, and proves, without a doubt, that you have the financial and managerial chops to make it happen.
Let's jump into Section 3, Organizational and Business Structures. This is all about the legal and operational setup.
Operationally speaking, there are four main types of organizational structures you're going to encounter out there. A functional structure groups people by supervision, management, and the allocation of specific responsibilities. A divisional structure means the organization is carved up into self-contained divisions, each operating with its own functions and resources. A matrix structure, well, that's simply a combination of the functional and divisional approaches. And a flat structure, which by the way is sometimes called an administrative structure depending on what books you're reading, features very few hierarchical levels. This means highly decentralized decision-making and a whole lot more autonomy for the employees.
Pivoting over to the legal side of things, there are 5 primary business structures you really need to know. A sole trader is just one individual. They have unlimited personal liability and complete, absolute control over everything. A partnership involves 2 or more entities with collectively unlimited liability. But then you have a limited liability partnership, or LLP, which grants those partners limited personal liability for any debts. A limited liability company, or LLTD, similarly offers limited personal liability, but it's uniquely structured through shares. Finally, a franchise allows a franchisee to carefully follow a pre-established business model. You might also hear the term joint venture. This is a really specific arrangement where 2 or more parties pool their resources for just a single task. In a joint venture, each party is responsible for its own profits and losses, but the venture itself operates as a completely separate entity.
Moving right along to Section 4, Market Analysis and Finance. Let's cover some essential tools and terminology.
2 absolutely vital market analysis tools you'll find yourself using constantly are SWOT and PESTLE. SWOT looks internally at your company's strengths and weaknesses, and externally at your opportunities and threats in the market. It's just a really highly structured way to formulate strategies that genuinely support your broader vision. PESTLE, on the other hand, is a framework for analyzing purely external, macro-environmental factors. The acronym stands for political, economic, socio-demographic, technological, legal, and environmental influences.
Let's transition over to the finance side for a moment and clear up some key terminology. Working capital is a financial metric representing the operating liquidity available to a business. Simply put, it's calculated as your current assets minus your current liabilities. Stock relates to shares or inventory. A debtor is an entity that owes a debt, while the party they owe that money to is called the creditor. We also talk a lot about financial benchmarking, which literally means comparing your company's business practices and performance metrics directly against other comparable firms in your exact same industry. To do this effectively, we rely on accounting and forecasting techniques that generally fall into 4 buckets, those based on financial accounting information, cost accounting information, forecasting future data, and other miscellaneous analytical tools. When it comes to that financial benchmarking, there are several key ratios you absolutely have to master. Take your net profit margin, for example. It is crucial because it measures your net income directly against your sales revenue. Similarly, your debt-equity ratio is vital for understanding your company's leverage. It assesses your external liabilities against your shareholders' funds. Getting really comfortable with these ratios, from return on capital employed all the way over to earnings per share, is going to give you the precise mathematical tools you need to evaluate the underlying financial health of any business. Of course, beyond the raw numbers, setting targets is a massive part of planning, and those targets should always be smart. Specific, measurable, achievable, rewardable, and time-bound. You'll likely end up managing all this using ERP, or Enterprise Resource Planning software, which integrates all your main business processes into one place. Now, for those of you specifically looking to operate under RICS regulation, there's a clear-cut 6-step process you have to follow. You must register with the RICS, appoint a designated contact officer, set up a strict complaints handling procedure, obtain professional indemnity insurance, establish rigorous client money handling arrangements, and follow all compliance rules for using the RICS logo. And from an ethical standpoint, this means a strict zero-tolerance policy for bribery, ironclad anti-money laundering protocols, absolutely prohibiting modern slavery, and ensuring rigorous data management and privacy at all times.
All right, Section 5, Exam Preparation. Core Q&A. Let's run through some rapid-fire concepts to test what we know.
Let's lock in these definitions. Business strategy is formally defined as the determination of the long-term goals and objectives of an enterprise and the organization's specific approach to achieving them. Strategic planning, however, is the managerial process of developing and maintaining a strategic fit between the organization's objectives and resources and its rapidly changing market opportunities. Basically, by utilizing market analysis, you identify business opportunities and critical success factors, which leads directly to the development of highly actionable strategies.
You hear the term best practice thrown around a lot, right? In this context, it refers to processes that meet a very high standard of professional competence. It essentially asserts that there's a specific technique, method, or process that is inherently more effective at delivering a particular outcome than any other approach out there. Ultimately, best practices are the most efficient and effective ways of accomplishing a task, based entirely on repeatable procedures that have proven themselves time and time again. To make sure these practices are actually being followed, managers use tools like time cards, project appraisals, client satisfaction surveys, and lessons learned workshops.
And our final section, Section 6, Exam Preparation Applied Q&A. Let's apply this to some practical scenarios.
Here is a fundamental, non-negotiable rule of business planning. If performance measurement does not reach the required level of the established goals and objectives, corrective actions must be taken immediately, no waiting around. To know exactly where you stand, you conduct a resource audit. This is a thorough assessment of the inherent strength of your resource base, typically grouped into physical resources, human resources, financial resources, and intangibles. In a standard professional office environment, project profitability is tracked continuously through regular fee and cost reconciliation. You're constantly monitoring timesheets against budgeted hours and forward planning your resources so that any variance from the agreed budget is flagged early to management for correction.
It's also absolutely essential to understand how your company's core values relate right back to the business plan. Core values set the basic principles the firm operates by, things like quality, integrity, or people development. The business plan's job is to translate those abstract principles into concrete, measurable objectives and actions, ensuring that your day-to-day decisions and your long-term strategy both reflect the exact same values. By aligning these things perfectly, you add massive value and generate a ton of additional business. You do this by delivering work to such an incredibly high standard that clients naturally return and refer others. By keeping close contact to anticipate their upcoming needs, cross-selling your services, and actively building your professional network.
We have covered a lot of ground today: the core concepts, the structures, and the practical, real-world applications of business planning level 1. So the real question is, have you internalized these principles enough that they flow naturally into your own strategic thinking? Take the time to test your own recall until these concepts become total second nature. Keep practicing, and thanks for watching this explainer.